Hello, welcome back. Over the last few weeks, I've had an influx of people wanting to know and learn about commercial property. What is commercial property? What type of people should be investing in commercial property? And in this video, I want to shine a light on what the asset class is and what type of people are suitable for buying commercial property. I'm actually doing this video from a retail premises in Coburg whilst waiting for my vehicle to be tinted. Now, what's interesting about commercial property is that it's a very broad asset class, and the term commercial is a generic one. It doesn't really mean anything when I hear commercial property. To me, commercial property is generally split into two classes: specialized and non-specialized. So non-specialized commercial properties, for example, are retail shops, factories, warehouses, and offices. And specialized commercial property are properties like childcare centers, storage centers, medical clinics, properties that are purpose-built for a particular commercial use. Now, the term specialized and non-specialized is really critical. Why is it critical? Because generally speaking, specialized commercial properties are not spec'd out. In other words, builders and developers do not just build these type of properties. What they do is they pre-commit. In other words, they find a suitable tenant or a suitable purchaser that wants to buy these type of specialized properties, and then they build them. So specialized properties are not commercial properties that are built on a speculative basis. In other words, they don't just build them and hope they get leased and purchased. Non-specialized commercial properties, however, are. So properties like shops can be used by different types of tenants. So one shop can be used by a bakery, a clothing store, an electrical store. It can be used by a multiple number of different tenants. Therefore, it doesn't need to be purpose-built, okay? The same with offices, and also the same with factories and warehouses. So in a factory and a warehouse, you can have many, many different types of tenants and many, many different types of uses from either tenants or purchasers that are looking to buy. Whereas with specialized securities, specialized properties, these are purpose-built for their intended use. So that's really, really critical to understand the difference between specialized and non-specialized. That's really where we need to start. So why do properties need to be split between specialized commercial and non-specialized commercial? And there's a very good reason for that. It's because that's what the banks do as well. So the banks internally have a higher risk profile for specialized commercial properties because there's a higher risk that when they become vacant, they may not be able to find tenants as quickly. There's a higher vacancy risk. Whereas with non-specialized commercial properties like shops and factories and offices, that risk isn't as high compared to specialized. These specialized commercial properties have been purpose-built. They've been as opposed to being spec'd out. In other words, the tenant has been pre-committed before they've actually built that property on a long lease. And there's always a risk that when that lease expires and the tenant's business isn't doing too well, there's a vacancy risk associated with that property. Whereas with non-specialized securities, you can always change a bakery, for example, into a news agency, into a takeaway. There are multiple uses that can be used for non-specialized commercial property. So that's the first thing you need to understand, that there are two types of commercial properties. There are specialized and non-specialized. In the residential investment space, people that buy residential properties for investment purposes, there is a significant emotional attachment to those properties, and a lot of purchasers are buying emotionally and justifying logically. So they're buying something emotionally, often overpriced, and then they're justifying it later on and talking about how great the kitchen is and the garage and the neighborhood, etc. And they subsequently learn a lot about the suburb and the street after they've purchased it, often trying to justify the purchase. That doesn't happen a lot in the commercial space for experienced and seasoned commercial property investors. And as you've seen in a previous video that I did with the Burgess Rawson auctions, portfolio auctions at the Crown Casino, these investors are seasoned and they're hardened, and what they're really looking for is a number. And if that if that number is not ticked, if that box is not ticked, then they move on to the next property. So there is a significant mindset change when you're moving from residential to commercial. And the main reason why people don't invest in commercial properties is because they don't know what to anticipate. They're not sure what comes next. How will someone help me if the property becomes vacant? How are the laws different? Will there anyone be there to support me? All these questions and doubts come into play, and typically what that leads to is inaction. And that's the primary reason why people don't buy properties in the commercial space, because of inaction, because of this ability not to be able to anticipate what they're likely to experience moving forward. So let's talk about commercial property, and I'm not going to differentiate between specialised and non-specialised anymore. I'm just going to talk about commercial property as a generic term. How do we know that we're looking at a commercial property? Well, for starters, the property needs to be zoned commercial. There are businesses that run from homes that are zoned residential, but they're not commercial properties. They're often what we call non-conforming use. In other words, the use doesn't conform with the zoning. But what I'm talking about is properties that are specifically zoned commercial. The commercial zoning can be there's various types of zonings, like commercial 1, commercial 2, commercial 3, but typically it's a property that's zoned commercial for commercial use. Okay, a commercial property is one where the zoning is commercial, right? We don't want the zoning to be residential used for commercial properties, because what that is, it's what we call a property that has non-conforming use. In other words, the use does not conform with the zoning. But once we've identified that a property is zoned commercial for commercial use, then what we need to consider, all properties have the same thing, and all commercial properties have the same thing. And what is that? So what that is that there's a tenant that's occupying that property that's trying to run a business. Okay, that's it. It's as simple as that. A tenant trying to run a business. Now, if you have a look at the business, and if you have a look at the tenant's profit and loss statement, what you'll see in the expenses column, you'll see a thing called occupancy costs. And what occupancy costs are effectively the rent plus the outgoings. Now, the rent is really critical, because the rent is the income that the landlord and that the owner receives. No different to the rent that a tenant pays in a residential property. The difference is, though, that with a residential property, the income that the landlord receives, whilst it's important, it's not the primary method of valuation. But when you're looking at a residential property, the primary method of valuation is what we call direct comparison, summation, and the capitalization of income is usually a third method, a check method, when you value residential property. However, when we're looking at commercial property, the primary method of valuation is the income approach, or the capitalization approach, where we're looking at the income and then we're capitalizing it to determine the value. No different to, for example, if you're buying stocks and you're looking at PE, okay, price earnings ratio. It's a similar concept. Now, so what's really important is that the income that the tenant is paying to the landlord, and that income, as I said, is part of the profit and loss statement. So so to a tenant, the income is an expense, but to the landlord and owner, that's their income. And from that income, we can derive a value. So that's really a commercial property. Just recapping, it's a property that's zoned commercial for commercial use, and it's a property, irrespective of whether it's specialised or non-specialised. It's a property that's primarily used, or that's mainly used to generate revenue. It's a business that generates revenue, and that it has expenses, and one of those expenses is the occupancy cost, or the rent paid to the landlord, okay? That's really a commercial property in a nutshell. So in summary, what is a commercial property? A commercial property is a property that's zoned commercial for commercial use, and irrespective of whether it's specialised or non-specialised, there is a tenant who's running a business, okay? Hopefully a profitable business. One of the expenses that the tenant has is occupancy costs, which are a rent. That rent is revenue to the landlord and the owner, and that rent is what we use as our primary method of valuation for that commercial property, unlike residential property, okay? It's very simple. That's all a commercial property is. It's a tenant running a business, paying rent to a landlord, and when we're valuing that property, we're using that rent. So the next step of every property investor is, once they've determined what the rent is, and usually the rent will be, you'll be able to find the rent in the lease, okay? So obviously it'll be disclosed, but the commencement rent and the lease terms, etc., will be in the lease document you'll be able to read. But the next step really for every property investor is to determine whether the rent that is paid by the tenant and that is received by the landlord, is it a market rent, right? Or is that rent above market? In other words, is the landlord getting profit rent, or is the rent below market, which means is the tenant making profit rent? So profit rent is something that I'll talk about in other videos, but it's very important to determine whether the rent is above market, below market, or at market. I've often seen commercial properties that have been bought with high rent because the owner has spent money or capital expenditure on the premises and has tried to recoup that money back by virtue of a higher rent that the tenant pays, and that's not automatically transparent to a property investor when they're buying a property. They simply see a lease with a rent on it without sort of understanding the mechanics or the history behind that rent. So it's really, really critical. For example, so to give you an example, you might have a market rent of $70,000 where the owner has spent maybe a couple of $100,000 on fixtures and fittings, and what it does is it adds on. Let's say, for example, it provides the tenant with a 5-year lease and it tries to recoup those funds over 5 years. So total expenditure divided by 5, they add on to the market rent. So the tenant then pays a higher rent and the landlord receives back all that money that they've spent on the refurb. So that often happens sometimes in some of these leases. And if you don't know what the market rent is, you automatically capitalize the what we call the passing rent, what the tenant is paying at the time. So that can be a mistake. So the next critical thing is to really understand what the market rent is. And how do we do that? Well, you need to look at comparable rentals. So for those buyers that don't have advocates, what they need to do is some homework to try and determine for that particular property, that asset class, the rent that the tenant's paying, is that rent a market rent or are they paying below or above market? That's really, really critical. That's the next stage. Okay, so we found our commercial property. We've determined that the zoning is commercial. We've also determined whether it's specialised or non-specialised. We know that the tenant is running a commercial enterprise, and in their profit and loss statement, in the expenses column, we know that they're paying an occupancy cost. That occupancy cost is revenue to the landlord. We've had a look at the revenue, and we know that that's governed by the Retail Leases Act, and the revenue, we've determined that it's a market rent as opposed to a profit rent to the tenant or the landlord. And now our job is to work out a cap rate. And with cap rates, we've talked about that on previous videos. Cap rates are no different to PE ratios that we see in the stock market. So what we then need to do is determine what cap rates do these particular properties sell for in the marketplace. So if you don't have an advocate or a valuer friend, typically what you should be doing is looking in the marketplace and seeing what properties sell for, going to auctions, speaking to agents, and finding out what properties sell for. So if we look at property like this one that we're here today, where I'm tinting my car. This is a retail outlet. I think it used to be a former petrol station site. And if assuming this was a petrol station, for example, typically this petrol station could have a cap rate, let's say, of 5.5% or 6%, right? And so what we then do is we apply a cap rate to the market rent or to the passing rent, assuming it's a market rent, and that gives us our value. So that's really what a commercial property is in a nutshell. But a lot of homework, a lot of work needs to be done beforehand to determine whether it's the right commercial property for the buyer. So that's when we need to look at location, we need to look at pedestrian traffic, potentially if it's a retail premises. If it's a factory, we need to look at ingress, outgress, whether the roller doors are contained at height, whether the building's obsolete, etc. And what's going on around that factory in terms of zoning changes. There's large industrial precincts, for example, in Melbourne, where it's hard for trucks to get in and out. Does that represent good value in the future for landlords? When you're looking at offices, you need to consider where these offices are located. Are they located close to transport hubs for employees to get in and out? Are they easy to get to? Are they modern? Are they obsolete in terms of their design? So there's a lot of, once you've screened the property initially in terms of its what type of property and the income and the market rent and the value of that property, you need to then consider, well, this property, is it worth investing? And remember what we're looking at. When we look at commercial property, we're not only just looking at durability of income. What we're looking at is potentially growth in that income. So how is that income going to grow in the future? When the lease finishes or when a tenant wants additional lease terms, will we be able to get more rent if the rent, for example, is connected to market rent? So will the market rent allow us to get a higher rent? So when you're looking at a property, one of the most important things is not only to look at durability of income, but can that income, can the location of that property and that property itself, can it become more attractive moving forward based on what's going on around it? So the income, the durability of income, the ability for that income to grow is really, really important when we're looking at commercial property. So hopefully this little intro on commercial property will get you to understand, or hopefully what you've learned is that there needs to be a significant mindset change when looking at commercial property, when moving from investing in residential property to commercial. Why? Because in residential, the way we value properties in the residential space is through direct comparison, where we're comparing one property to another. We're also summating that property. We're looking at the land value and the value of improvements, and the yield and the rent is a tertiary thing that we look at. So it's just a check method. That's not the way people buy residential property, or most people, even investors, they look at capital growth over cash flow. So when buying residential property, there's a mindset change. When you move into commercial, you're really looking at income, you're looking at the durability of income, and you're also looking at the ability of that income to grow moving forward. But there's a big mindset change, and I'll tell you a funny story. I was looking at a property in St Kilda in Fitzroy Street, and there was a residential agent trying to sell a commercial property. It's quite funny actually, because I was looking at that particular shop, and the shop had a vacant shop around it, and when I talked about my concerns about the shop, he would talk about the beach and how close it is to the beach, and all these other things that really didn't matter. So not only do agents have a problem making that change from being residential agents to commercial, and I just see it all the way in the way they talk, so you can feel it in the language. So the same thing applies to investors who are making that change. So that change also too is not as easy as what you hear on YouTube channels, and there are a lot of spruikers out there that make commercial investing sound like it's easy. It is easy if you know what you're doing and you know what to anticipate, and you can reduce the risk significantly. But if you don't know, then what I would highly recommend is that if you don't have an advocate, then find a friend or someone, a relative or someone that invests heavily in the commercial space, and learn from them. So that's my advice moving forward. Any help, please send me a text or send me an email if you need any assistance. But I'll be talking a lot about commercial property moving forward, but really day one is mindset change.